How big does a little bit of extra return, or maybe even a little bit smaller expenses, make to your overall retirement picture? Well, we got some interesting stats on that, along with some of the latest research. Not really latest, I think this is about a year or two old, but some interesting research we wanted to share on who exactly is a millionaire in America today. So welcome to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of networks throughout Central Florida, plus of course our podcast, recently named one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast platform or social media platform of choice. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So one of the biggest tax breaks that exists out there today has to do with the sale of your primary residence. And in fact, for a married couple, it's a $500,000 tax break on the sale of your primary residence. And what's particularly important, of course, in today's world is you've got a really hot real estate market. A lot of people are making more on their homes than what they might otherwise have had the possibility of doing just a year ago. And so folks need to understand that there could potentially be some tax implications on that. And what's interesting is that the rules involving the sale of a primary residence actually changed over 20 years ago, back in 1997, but many folks still operate under the old rules, the pre-97 rules, when the only option that you had to exclude the gain from your primary residence was one time in your life you were able to sort of quote unquote downsize, sell the big house, go into a smaller house, retire, if you will. And at that point, that step down, if you will, allowed you your one-time lifetime exclusion. And it's funny how many people still think that that is the rule, when the reality hasn't been around for over 20 years. The new rule is much more flexible than that, and in fact allows people to take advantage of it on a somewhat regular basis. So the new rule works like this. If you have lived in your home for at least 2 years, and we're going to get into some of the specifics in this segment as to some of the rules that you need to make sure that you're observing in order to qualify for this particular tax break. If you're selling your home and there is a gain and you are a married couple, then you've got the ability to exclude $500,000 of that gain on your tax return. If you're a single person, that number is $250,000. So here's how it works, right? I buy a house for $500,000, I sell it for $1 million. Hey, if that was my primary residence, guess what? I don't have to pay taxes on any of that. So it's a pretty powerful tool that allows folks and is unique to primary residences, because that exception in terms of not having to pay this capital gain only exists on primary residence. And when you stop and think about it, the home for many Americans is the single largest asset that they will have, combined with the fact that the tax nature of that asset is the most tax advantaged out there, because that is all after tax money, right? You didn't buy your primary residence with contributions to an IRA. You didn't buy your primary residence with your 401k. No, you bought it with after tax money. So from a tax nature, your primary residence is in fact very unique and subject to a much lower tax structure anyway, as a result of not being a retirement account. But in this particular case, what makes it even sort of much more spectacular in terms of the tax benefits is that when you sell, assuming the gain is below $500,000 as a married couple, below $250,000 as a single person, there is no tax owed on that in any way, shape, or form. Now, technically, this provision is referred to as, or this exemption is referred to as an exclusion, meaning that you still have to report the sale of the primary residence on your tax return. You still put it on Schedule D, just like you would the sale of any type of capital asset. But yet you can take an exclusion of the gain, again, up to those $250,000, $500,000 limits. Now, here's the kicker. To qualify, you must have lived in the house as your primary residence for at least 24 months of the trailing 5-year period from the sale date. So let's say you sold the house on June 1 of this year, June 1, 2021. So you would go back from 5 years back, right? So the June 1 of 2016, and look at that 5-year period of time. And if during that 5-year, that 60-month period of time, that house for at least 24 months was your primary residence, then you are eligible for this exclusion. So obviously that's something to really kind of watch the calendar, if you will, in order to qualify for this, because if you miss it, then it's a pretty significant difference in terms of how it plays out. Now, the reality is that the 24 months in the trailing 5-year, there's a lot of exceptions to that, a lot of nuances. If there's a separation or divorce or military service, those types of things are unique. And so there's a lot of different exceptions to sort of how this sort of rule plays out in those more unique situations. But just know that the general rule, the general standard is it's only got to be 2 of the last 5 years that you've lived in it as your primary residence in order to be able to take advantage of this exclusion. Here's the other thing about this exclusion is that the rules are that it has to be your primary residence for 2 years, but it doesn't stipulate that you can only use it one time. You can use it as often as you want, and it's not a lifetime limit, if you will, of that $250,000 as a single person or $500,000 as a married couple. It is a per transaction. So in theory, every 2 years, you could be selling your primary residence, making $500,000 of a gain, and not having to report that. You do it again, 2 years later, you do the same thing. You make fortunate enough to make another $500,000, not taxable. That is part of the exclusion. So what's interesting about this exclusion from gain on primary residences is that you can use it as often as you want. And it's really kind of interesting to see that, particularly down here in Florida with the hot real estate market, of how many folks are able to sort of take advantage of that, and not just take advantage of it once, but take advantage of it 2 or 3 times. Now remember, we're talking about gain here. So what a lot of people think about is, well, I bought the house for X back in 2005 or whatever the case may be. The reality is that to that number, you would add in the cost of the improvement and the cost of the real estate transaction. So oftentimes what people think of as their sort of original basis in their property is much lower than what it is in reality. So when you redo the kitchen or you redo the windows or you do all of those things, all of that adds to the basis. So ultimately, most folks find that, particularly if they've put money into their home, that they wind up sort of shrinking down the amount of that gain anyway, because the gain, like any asset, anytime you sell anything, the gain is measured versus your basis value at the time that you sell it versus your basis. But what goes into basis is not just what you bought it for, but also what you did along the way. So just know that there is some calculations that need to be into play on that when you look at this particular exclusion. But the rules are very, very different than they were 20 odd years ago. Much greater flexibility, much greater ability to use it more than once, and an easy way to capture tax-free, effectively, the appreciation on what is, for most Americans, their single largest asset. So this sale of home exclusion really is some pretty powerful stuff that allows folks to do it and to take advantage of it really every couple of years. So some pretty interesting, pretty powerful stuff. Know that, particularly in a hot real estate market, that hey, you may not have the kind of tax implications that you may think, particularly with how these rules work. Anyway, when we get back, we will continue the conversation on something we talked about last week in terms of how big of a difference even a slight change in expenses or return makes to your retirement. Coming up next here on Dollars and Cents. Last week on the program, we were talking about the three things that make everybody's retirement situation, everybody's financial plan unique. And to recap, the three items were time horizon. Everybody's time horizon is very unique, and so one person's time horizon versus another can make a big difference in terms of what their financial and retirement picture looks like. Expenses, right? I mean, how much money you are spending in retirement can make a difference of whether you need like $5 million in retirement or maybe only $500,000 for retirement. And then lastly, we were talking about the rate of return. The rate of return that you achieve over the course of your time of saving money makes a big difference, of course, over time as to how much money you actually have to spend in retirement. Today, we're going to focus specifically on sort of the rate of return aspect. More importantly, specifically the impact of performance and expenses, because rate of return, of course, includes two things when you think about rate of return, because at the end of the day, as an investor, you want to be measuring your rate of return versus what you're actually getting, right? I mean, it's one thing to say, oh, my gross rate of return is blah, but if your expenses are like 3%, well, then that wasn't really your rate of return, right? So remember that when you talk about rate of return, how much it matters is really important when you consider that there are two aspects to that rate of return. There's the return part, and then there's the part that sometimes can get lost in the conversation, and that is the expenses part of that. So it's really, the thing you got to focus on is not just your rate of return, but really what your net rate of return is after expenses. And expenses can take the form of many different things, right? There can be the underlying investment expenses, there can be the advice expenses, whether that's called a fee or a commission or a assets under management fee or any of those types of fees that are associated with it. And there's a lot of different names out there. There's probably like 30 different names in terms of the adjectives or the descriptions that people use to describe sort of what the cost is. But just know that there's always sort of two costs when it comes to any investment, right? There's the underlying expenses of the investment themselves, and then there is the underlying expenses of the advice side or the financial side or the distribution side, whatever that case may be. There's always those two numbers. Now, what's interesting on the expense side for the advice is that post 2018, none of that stuff can be deducted anymore. And that was a pretty significant tax change that we saw in 2018. Now, before 2018, investors could claim a deduction for their advice fees, for their financial fees, for the custodial fees, for the trustee fees, for the tax fees, all of those fees, if you will, for professional services involving dollars were able to be deducted on your tax return. Now, to qualify, you had to itemize, but again, before 2018, approximately about a third of Americans itemized. Today, that number is about 7%. So the numbers have really shifted on this pretty dramatically, and particularly there was this elimination of all of these miscellaneous itemized deductions, which included the ability to deduct financial types of fees. So prior to 2018, what you would do is if you were itemizing your taxes, there would be a space for miscellaneous itemized deductions. Now there was a threshold that you had to apply, and that was 2% of your adjusted gross income. So let's say your adjusted gross income was $100,000 and you had trustee fees, financial fees, custodial fees, all of that of $4,000. Well, the threshold you had to get above 2% of adjusted gross income. So adjusted gross income was 100 grand. The first $2,000 was the threshold that you had to get above. So none of that first 2,000 counted, but the second 2,000, if you will, you're able to take a deduction for it. Unfortunately, all of that fully eliminated, and so those fees, if you will, and how much you pay become even more important, because they can certainly be a drag on your rate of return, particularly even more so now because you don't have the ability to even turn around and get any level of tax savings off of those fees. So it's really important to kind of really look at, sort of back to the question of how much does even a slight improvement in performance, or similarly a slight reduction in the amount of expenses to make that bottom line. Again, think rate of return. Rate of return is how well am I doing, but also what are the expenses involved to get to that number. So it's really more about the net rate of return, not the gross rate of return. Well, the reality is that even a little bit of a difference can make a huge impact in your retirement. And frankly, when I first saw this, it really kind of surprised me, because we're not talking about a significant difference in terms of the numbers, but rather the impact really can be dramatic. So let's paint the background, if you will, on the analysis that we saw that was done on this. And so let's say that you start at the age of 25 and you save 10% of your income, starting out at a normal annual salary of a 25-year-old at $40,000, although at the end of the day that's actually a pretty decent salary, and you keep doing that until age 65. So every year, starting at 25 going to 65, you simply take 10% of your income and put it away. Pretty good general rule of thumb anyway in this particular example, and that's certainly something that you want to be doing. So what's the difference, or what's the impact of 0.5% per year on that investment time frame or the distribution strategy that's available in retirement? So 0.5% per year, you say, this probably doesn't make that big of a difference. Here's the reality. A 0.5% difference, whether that means a better rate of return through a better investment allocation, or being more mindful of how much the expenses are in the investment product that you're using, and combined with that, the expenses that you're paying to the person that you're talking to, the reality is that a difference of 0.5% per year can add an extra 5 years of retirement spending. Sounds pretty good, right? Now, here's how more dramatic the numbers become if you find a difference of 1% per year. Again, talking about a scenario where a person starts at age 25, saves 10% of their income, and we fast forward to age 65. During the course of that 40-year period of time, if there was a difference of just 1% in the rate of return. Remember, last week we were talking about why everybody's retirement situation, why everybody's financial situation is unique, is because there's a uniqueness of these factors that go in. A lot of these cookie cutter models, computer-based models, they make these assumptions, but everybody is very unique in terms of the numbers. So if you wind up just having that 1% difference, you wind up adding an extra 13 years to your ability to spend in retirement. Obviously, that's pretty potentially significant. Bottom line on this, make sure you understand the aspects of the rates of return and what goes into it. Yes, it's the investment allocation. That's a big part of it, but it's also about the underlying expenses. And even a little bit of a difference can add some significant years to your ability to spend in retirement. Coming up next year on Dollars and Cents, we'll talk about some of the things to do before you take that retirement leap. Coming up next on the program, Dollars and Cents. So what are some of the things that you need to do before you make that leap into retirement? In this segment of the program, we're going to give you some things to be thinking about as you approach retirement in the 12 months prior to retirement. Well, reality is hopefully you've been thinking about your retirement a little bit more than 12 months prior to, but this is sort of a checklist, if you will, of the things that you really need to be focusing on as you take that leap into retirement. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of networks throughout Central Florida, whether it's 96.9 The Game, News Radio WFLA Orlando, or most recently welcoming our friends over on the Space Coast at 92.7 WMMB. Of course, our podcast channels as well, percolating along over 17,000 downloads of our program over the course of the past few years. So we welcome our podcast listeners as well. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So you're thinking about getting ready to retire. What are some of the things, if you will, what should you be putting on that checklist to make sure that you have thought about some of the more important things before you make that jump into retirement? Well, first and foremost of all, one of the biggest parts of your retirement income is going to be Social Security. So you really want to sort of work through what impact Social Security is going to have and when you should take it, because there's some different years to be thinking about. You can take it obviously as early as 62, but that amount is reduced from what your full retirement age is. So your full retirement age is a little different for folks these days because you've got a group of folks that are sort of going in the transition from 66 to 67. The reality is that in a few years' time, the full retirement age for everybody is going to be 67. So that when you get your Social Security statement, there's a number that appears on the front page in terms of how much monthly income you're going to get. That number on the front page represents the amount that you will get at your full retirement age, which again for most people is going to be 67. The other age is age 70 for Social Security, which means that you can wait, delay, defer taking Social Security, and it goes up by 8% per year between those years of that full retirement age and age 70. So lots to think about in terms of the Social Security income strategy. That's why as part of the team at Nelson Financial Planning, we have Rob Field, who is a national Social Security advisor, to help our clients sort of look through all of the different options that are available to you in terms of claiming Social Security, because that's going to be a big part of your income in retirement. Similarly, the next thing you need to look at is sort of the tax consequences of your retirement plans. And here's where people sort of kind of lose track of what their numbers are that they need in retirement, because everybody says, well, I get $4,000 a month and that's what I'm able to live on, or $5,000 a month, or whatever the case may be. But what you're getting in your checking account is your net number after taxes have already been taken care of. What happens in retirement is that you've got to be responsible for making sure that those taxes are all getting paid. Now, the good news on that is you don't have to worry anymore about FICA tax, Social Security tax, Medicare, Medicaid tax. Those you do not have to pay on retirement income, but you've still got to pay the income taxes. So understand that now you've got to sort of gross your numbers up so that you can make sure that every month there's some money going out that goes to the IRS. Much like your employer is doing now in retirement, you become responsible for doing that. So just again, like retirement in the last segment about rate of return, gross versus net, Same thing when it comes to retirement income as well. Gross is different than net. Don't forget, you got to pay the tax man. And in order to really get a good handle on that, that requires you to understand the difference of the different tax nature of the assets that you may own. So there's pre-tax and there's post-tax. Pre-tax is traditionally like a 401k or an IRA. All of that money that comes out is going to be taxed as ordinary income. On the flip side, after-tax money, post-tax money, maybe it's money that you made from selling your primary residence, like we were talking about earlier in the program. That money is post-tax money, so that money is not subject to the same level of taxation, and in fact, for the most part, is taxed as dividends, capital gains, things like that. Those types of income items are taxed at a different rate than income. So understand the tax consequences of your retirement plan. Again, that's why as part of the team at Nelson Financial Planning, we have not only a CPA, but also an IRS enrolled agent on as part of the team to really kind of dig into these numbers and make sure that the picture is as accurate as possible. Next up, again, these are some of the things to be thinking about before you leap into retirement. You want to sit down and sort of make sure that your documents and your beneficiaries and your estate plan are all in good shape, right? It's a good opportunity to sort of reflect on that full financial picture, not just, okay, now I'm going to jump into retirement and start getting income off of what I've accumulated over all of these years, but it's also important to just kind of make sure that everything, the I's are dotted, the T's are crossed. So that involves sort of looking at all of your different accounts and making sure that beneficiaries are named on them. Here's the reality of it. If you name a beneficiary on an account, it becomes much, much easier for that account to transfer to those folks once you pass. If you don't name a beneficiary, then it's going to go through your will, it's going to go through the probate process, and that's going to be time consuming. So make sure you're naming beneficiaries, and then similarly make sure you have all of those various estate documents in order, not just a will, but also sort of a power of attorney, living will, those kinds of things. Remember last week on the program we talked at length about a power of attorney and some of the different aspects of it. And certainly you want to have those types of documents in place. So another thing to sort of put on the checklist before you jump. And then you obviously want to be looking at your investment allocation, right? If you're about ready to retire, this is certainly something you should have been doing along the way. You're sort of tweaking the allocation as you get closer to retirement. But in basic terms, the investment approach should be shifting from sort of a growth approach to more of a growth and income approach. So ultimately, that transition should have been one that is happening as you get closer to retirement, but certainly you really want to be looking at that investment allocation, particularly as you're about ready to jump into retirement. But be careful on that. I think far too often what we see is that folks are going way too heavy on the bond side of things. And unfortunately these days, not much of a rate of return on the bond side. So be careful before you get too far into that conservative side. Remember, your assets have to last you. If you're retiring at 65, married couple, the odds are like almost 100% that one of you will make it to 85. So that's a 20-year time horizon. So you want to be careful that you're not getting too conservative, if you will, when you make that jump to retirement. Some of the other things that you may want to be thinking about is your healthcare options, right? That's pretty important because now you're going to be responsible for finding that on your own. Again, that shift from being sort of under an employer versus now it's all you. One of the biggest things that folks have to really do some homework on is this notion of finding the right options for healthcare. It's estimated that the average 65-year-old couple can expect to pay almost $300,000 in medical expenses during their retirement. So important to get the right health insurance. So those are just some of the things that you need to be thinking about or looking at before you make the leap into retirement. With that, we'll take a break. When we come back, we're going to give you some interesting stats on millionaires and what it takes to be one in America today. Coming up next on Dollars and Cents with Joel Garris. So you want to be a millionaire. What does it take? What do you need to have in terms of the background or the expertise, or what does all of that involved. And obviously there's a ton of speculation, right? That you've got to, inherit money, or you've got to go to an Ivy League school, or you've got to be a doctor, lawyer, or Indian chief. That at the end of the day, it's not about the path. It's about making sure that you're inheriting money, or you're getting a big job, or you go to a big school. And what's surprising about some of the latest data is that, for the most part, the average millionaire in America today is an average person with average income and no inheritance. And so we're going to share with you some of the numbers and some of the statistics that have come out of the latest study that's been done on all of this. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us through your favorite podcast platform of choice, along with the fact that you can see us on our YouTube channel as well at Nelson Financial Planning. In fact, one of our associates, Garrett Fields, did a segment on this very topic and put it up on our YouTube channel. So if you're interested in hearing more, make sure you check that out. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of being successful, this is a fascinating study that was done by an individual by the name of Chris Hogan. Now, for our Dave Ramsey fans, you will know exactly who Chris Hogan is. He is one of Dave Ramsey's primary associates. And so what Chris did back in, it was actually 2019 when he wrote this book. There was a book called The Millionaire Next Door that was published in 1996. Hard to believe that book is that old, but that book wound up being opening up an interesting conversation about who actually is a millionaire in society today. I think we have a lot of preconceived notions that you have to go to a good school, you have to inherit a bunch of money, or you have to be a doctor, lawyer, or Indian chief in order to be able to have that kind of money. And so The Millionaire Next Door, the book that was published back in 1996, sort of went and sort of debunked some of that stuff. But the problem with the book, The Millionaire Next Door, is that it actually had a relatively small sample size. So that was always sort of the knock on it. So in 2019, Chris Hogan, again, as we mentioned, one of the Dave Ramsey's associates, recreated the entire study and in fact pulled information from 10,000 participants. So obviously much larger sample size. And he created a book that wound up being a bestseller entitled Everyday Millionaire. So here are some of the stats from it, which we thought were kind of interesting, and we wanted to kind of share with you on the program today. So those questions, if you will, that we often think, or the assumptions that we make in terms of who has wealth and who doesn't, this book that Chris Hogan did just really debunked each and every one of them. So we'll start with sort of the three main ones, if you will. And the reality is that, when asked the question, or when looking at the analysis of do millionaires inherit their wealth, here's the interesting statistic. 74% of millennials and 52% of baby boomers believe most millionaires inherit their wealth. Well, the data says that assumption or that belief is completely false. Only 21% of millionaires receive any inheritance at all. That means 80% or 79% are able to generate that without any their wealth without any inheritance whatsoever. Just 16% of those that inherit more than 100,000, and a mere 3% inherit 1 million or more. That means that, in essence, 79% of all millionaires are self-made. Yet, the overwhelming assumption in society, 74% of millennials, for example, assume that most millionaires inherit their wealth. The opposite of that is true. 79%, nearly 80%, don't inherit anything at all. Next assumption, or the assumption that I think we make in society, is that, well, millionaires have to go to big schools, right? They have to go to Ivy League schools, and that's the ticket to becoming rich. In reality, is if you look at tuition at these schools these days, it's probably a ticket to becoming poor, considering how expensive schools have become. The reality is that the findings in this study, again, this is Chris Hogan's study, 10,000 different participants, so a pretty large sample size. 62% of millionaires graduated from public state schools, and nearly 1 in 10 didn't even graduate from college. Another interesting thing to note when kind of looking at this part of the data, half of all millionaires earned a B average or less in retirement. So they weren't really at the top of the class either. So they went to public schools, they went to public colleges, they didn't go to fancy Ivy Leagues, and at the end of the day, they had mediocre grades. So I guess, you know, that's good news for my son at Auburn, who's, you know, might not be exactly hitting the top level in terms of the grades. That's a conversation that we have on an all too regular basis at the house. But anyway, I digress. So, but just don't share with him this part of the, you know, the bottom line of the studies, because he's going to then say, well, my grades are fine. Anyway, no, he does fine. Anyway, so the next assumption that a lot of Americans make is that millionaires have a high salary, like that's how they were able to accumulate that, is because they were making a ton of money, doctors, lawyers, Indian chiefs, stuff like that. The reality is that only 15% of all millionaires were CEOs, CFOs, or COs, sort of the C-suite people, the leaders in a particular business. Only 31%, so just under a third, averaged a $100,000 annual income. And in fact, a third of all millionaires never earned a six-figure salary. So that's over 100 grand. A third of all millionaires never earn a six-figure salary in a single year of their career. So some pretty interesting statistics in terms of kind of what the typical millionaire is. It really sort of debunks that myth that we all share of, oh, they must have inherited a bunch of money, they must have gone to an Ivy League school, they must have a really important, powerful job that pays a bunch of money. The reality is it sort of underscores, right, some of the keys to accumulating wealth over time. And those keys are concepts that we've talked for years on this program, but I think it boils down to sort of 4 keys, if you will. First and foremost, start. Just do it. Just start saving money. And then number 2, make sure you do that sooner rather than later. And then number 3, number 4, be consistent, be diversified. That's what this study is really all about, that debunks some of the myths that we have on who is a millionaire and who isn't in society. It's about the fundamentals. It's about the fundamentals of investing. It's about starting. It's about doing a little bit, but doing it consistently over an extended time period. So some interesting stats on what it takes to be a millionaire in society. With that, we'll wrap it on up and get on out of here. Thanks for listening to Dollars and Cents with me, your host, Joel Garris of Nelson Financial.